to recognize in future quarters as the underlying products and services are shipped and installed. In addition, during the quarter, a significant customer order was delayed and fulfilled across 2 reporting periods due to supply chain constraints affecting both our vendor and distribution channel. These constraints altered the cost structure associated with fulfilling the order. The initial shipment completed in the first quarter of 2026 was recognized at expected margins, while the subsequent shipment completed during the second quarter incurred a higher component and freight costs, resulting in a loss on that portion of the order. As a consequence, the combined order resulted in a loss, which contributed to the increase in cost of revenue described below and negatively impacted our results of operations for the 3 months ended June 30th, 2026. Net loss for the 3 months ended June 30th, 2026 totaled $1.4 million, compared to net loss of $1.1 million for the 3 months ended June 30th, 2025. Adjusted EBITDA for the 3 months ended June 30th, 2026 totaled negative $0.6 million, compared to negative $0.4 million for the 3 months ended June 30th, 2025. Cash used in operations of $0.6 million for the 3 months ended June 30th, 2026, compared to cash used in operations of $0.9 million for the 3 months ended June 30th, 2025, primarily related to our sourcing of inventory in connection with the increase in procurement revenue. Deferred revenue was $4.5 million as of June 30th, which will be recognized as revenue in future quarters as product and/or services are installed. And as June 30th, we had $7.5 million of cash and cash equivalents on our balance sheet and no long-term debt. For the 6 months ended June 30th, 2026, total revenue increased by 14% to $12.8 million from $11.2 million for the comparable 6-month period in 2025. The increase was driven by increased management information technology revenue attributed to both new customers as well as the expansion of services sold to existing customers and an increase in procurement revenue related to the sale of AI equipment to customers, partially offset by decreases in professional services revenue and subscription revenue. For the 6 months ended June 30th, 2026, revenue totaled $12.8 million compared to $11.2 million for the 6 months ended June 30th, 2025, an increase of 14%, primarily attributed to an increase in our managed IT services of 9% compared to the prior period, as well as an increase in procurement revenue of 70% compared to the prior year period. Net loss for the 6 months ended June 30th, 2026 totaled $2 million compared to net loss of $0.2 million for the 6 months ended June 30th, 2025. Adjusted EBITDA for the 6 months ended June 30th, 2026 totaled negative $0.8 million compared to negative $0.9 million, respectively, for the 6 months ended June 30th, 2025. Cash used by operations of $0.8 million for the 6 months ended June 30th, 2026, compared to cash provided by operations of $0.9 million for the 6 months ended June 30th, 2025, primarily related to our sourcing of inventory in connection with the increased procurement revenue. That concludes my review. I will turn the call back to Jason.
Our objective has never been simply to sell technology. The objective is to become a strategic technology partner that manages increasingly larger portions of our customers' IT environments. That creates recurring revenue, higher customer retention, stronger operating leverage, and greater lifetime customer value. Those are the characteristics that build durable enterprise value. Another major growth driver is infrastructure. We continue to see customers accelerate investments in compute infrastructure required to deploy applications. Procurement revenue increased 64% during the quarter compared to the prior year period, driven primarily by customers investing in servers, storage, and infrastructure supporting business and AI applications. Although procurement revenue is inherently project-based, it often serves as the entry point into long-term managed service relationships. As customers expand their technology footprint, they increasingly require ongoing cybersecurity, cloud management, monitoring, disaster recovery, and managed IT support. In other words, today's infrastructure deployment frequently becomes tomorrow's recurring revenue customer. That is exactly the type of customer lifecycle we are building. As Kara noted, one issue that impacted the industry during the quarter was supply chain availability. Demand significantly exceeded component availability for memory, CPUs, and GPUs. The important point is that the customer demand did not weaken. Orders were booked. Customers remained committed. Revenue recognition was simply delayed because products could not be delivered and installed before the end of the quarter. Those revenues remain in our pipeline and will be recognized as fulfillment occurs in the coming quarters. We've already responded by broadening our supplier ecosystem, expanding relationships with distributors and manufacturers, and improving procurement flexibility. These actions should reduce execution risk while improving our ability to respond as AI infrastructure demand continues to accelerate. The quarter also included an unusual margin impact associated with one large customer order fulfilled across 2 reporting periods. Changes in component pricing and freight costs resulted in a lower than expected gross margin on that project. We view this as an isolated operational event, not a structural change in our pricing model or competitive positioning. Our balance sheet remains another important differentiator. We ended the quarter with approximately $7.5 million in cash and no long-term debt. In today's environment, financial flexibility is a competitive advantage. It enables us to invest organically while simultaneously evaluating strategic acquisitions that can accelerate our growth strategy. Capital allocation remains disciplined and focused on maximizing long-term stockholder returns. Our priorities are straightforward. First, invest in initiatives that expand recurring revenue and increase customer lifetime value. Second, pursue strategic acquisitions that strengthen our technology platform, expand geographic reach, or add complementary capabilities. And third, maintain a conservative balance sheet that preserves financial flexibility. We believe this disciplined approach positions us to create stockholder value over time. As we've discussed previously, consolidation opportunities continue to emerge throughout the managed services, cybersecurity, and cloud infrastructure markets. Many smaller providers possess attractive customer relationships but lack the scale, infrastructure, and capital necessary to compete effectively. With our strong balance sheet, proven operating platform, and integration experience, we believe IPM is well positioned to act as a consolidator when attractive opportunities arise. We are interested in businesses that increase recurring revenue, enhance our technology capabilities, and generate attractive long-term returns on invested capital. Our objective with acquisitions is not simply to become larger, but to become a higher quality business. Ultimately, we believe investors should evaluate IPM based on the long-term trajectory of the business rather than quarterly fluctuations. We believe IPM is positioned to generate sustainable growth, expand profitability over time, and create meaningful long-term value for our stockholders. Based on our current outlook and the execution plan we laid out at the start of the year, our goal remains to be positive adjusted EBITDA for the fourth quarter. I'd like to thank our employees for their outstanding execution, our customers for their continued confidence, and our stockholders for their ongoing support. We are excited about the opportunities ahead and remain confident in our ability to build a significantly larger and more valuable company.
We will now answer a number of questions that have been submitted via email by investors. The first question is, demand remains healthy and new customer additions were robust. Can you provide more detail on the types of customers driving that growth? Can you talk about your traction in developing new accounts in the highly regulated industries, including legal, healthcare, and others? I'll send that to Jared.
Thank you, Joe. We are continuing our successful efforts of leveraging a customer we have to acquire customers. With our strength in highly regulated industries and our current repertoire of customers, we've leveraged customer case studies and referrals to go after additional accounts in each vertical area. During the reporting period, we had specific success in legal and finance and a strong pipeline in healthcare, energy, private equity, manufacturing, and retail.
Question number 2. Revenue continues to grow, but it looks like there was a decrease in revenue from a related party. How should we think about that going forward, and what does that mean for the business? Again, I'll send it to Jason.
Well, revenue from NewtekOne, a related party, decreased for the quarter in connection with their ongoing initiatives to reduce their information technology spend. While they are a very important customer, they are just one piece of the business, and we demonstrated this quarter we remain dedicated to not just meeting their evolving needs, but growing the overall business.
And it was mentioned supply chain constraints, delaying revenue recognition. Have those constraints eased in Q3? And when do you expect normalization, Jason?
The constraints of nature and unpredictable business with lower gross margins than the rest of the business. We have substantial capacity in every other area. In addition, we recently diversified our distributor, vendor, partner, and manufacturer relationships to better solve for any future constraints in the procurement side of the business. As I also mentioned, it's important to remember that bookings, billings, and GAAP revenue each measure different aspects of our business. Amounts recorded as deferred revenue on our balance sheet are recognized as GAAP revenue over time as the related services are delivered or contractual obligations are fulfilled. As of June 30th, 2026, $6 million or $600,000 over December 31, 2025.
Is this structural or a timing-related issue?
And growing. However, customer timing and resource constraints can occasionally cause delays in customer engagements, which can have an impact on billing during any given period. The good news is IPM has a significant pipeline.
And Jared, the Phoenix Data Center agreement, which was extended through this provide, and what utilization levels do you expect?
An institute certified with a 100% uptime guarantee, IPM was able to negotiate a heavily discounted rate for significant capacity, private cloud AI, and managed backup and DR segments of the business. IPM is able to leverage hyperconverged assets the business for future client onboardings.
Okay, well, that concludes our Q&A session for today. We will look forward to talking with you again after the conclusion of our third quarter. Have a great rest of your day.
Thank you very much. This does conclude today's conference, and you may disconnect your lines at this time. Thank you for your participation.